Welcome back, my passive income investors. I like to the two stocks I'm buying June 2021. These are stocks I picked up from my parents, my girlfriend, and I will be justly buying for myself in the renewable sector, along with the tech sector to give us a little bit of growth, along with some stable dividends. And let's kick it off with numero uno being basically Algonquin Power and Utility Corp, a Canadian utility that is globally diversified that might as well bring every kind of utility into one little basket. And what do I mean by that? Well, they do everything from the transmission lines like Hydro One. They've been involved in natural gas. They've been getting involved in everything from wind to solar. And heck, I think there's even a whole nother sector dealing with water and waste based off this company's management doing an incredible job scaling this over time. I'm going to address a lot of the issues I hear about with Algonquin Power, talking about some of their debt. We're going to get into some of the bottom line earnings and why they keep showing a net loss. But taking a look at the company where it sits today, guys, even though it is trading down 16% from its all-time highs, it is currently still up 60% over 5 years. If you cap in the dividend, you are getting much closer to, I think, about a 90% return over the last 5 years. With the current starting yield, if you were to put some money in this today, you'd be getting 4.44%. So for every 10,000 invested, you would bring in $444 annually here, folks. And speaking of the dividend, take a look at these increases. Oh my goodness, guys, they have over doubled the dividend in the last 10 years. So if you can buy this, hold on to this, and they continue to do what they do, which I believe the payout ratio sits somewhere around 40%, plenty of room to keep growing the dividend based off the underlying EPS. However, just taking a look, guys, from literally from 2011, the dividend was 0.07 cents. Today, it is sitting at 0.17 cent. So literally your dividend yield in the next 10 years could very potentially grow to an 8 or 10% yield. This is how people like Warren Buffett have become extremely wealthy buying companies like Coca-Cola. Most people aren't even aware Buffett literally makes a 50% return just off the dividends over the years of them increasing as he's owned Coca-Cola here, folks. And that's kind of what would happen with a stock like this. Could you imagine holding on to something like this for 20 or 30 years? The dividend yield would eventually get up into the 20% range. Now, I know that's a long ways out, but again, when the starting yield is already at 4%, it is a rarity to find such a high yield that still continues to increase year over year. So taking a look at the underlying fundamentals themselves here, folks, we can see the total assets sit at 13.2 billion against the liabilities of 7.5 billion, giving them an underlying asset of what, somewhere around 6 billion, give or take. So they're trading at almost double the market cap. However, this is still a very good value, I think, from where it currently sits. Now, further dabbling down into the business to reiterate how diversified this and crazy this is, guys, because again, with Hydro One, it's like pure utility lines. With a Northland Power, which is the pure renewable play, Canadian company that I love. However, that one is pure renewable. This one is like the ETF, in my opinion. It's just beautiful. So take a look at these acquisitions that have built up the whole company, because they're made up of subsidiaries. You got New York American Water acquisition, Bermuda Electric Utility acquisition, St. Lawrence Gas acquisition, Odell Wind Facility, Deerfield Wind Project, Park Water acquisition. It goes on and on and on and on. And just taking a look at the diversity of just their power and utility corp aspect of the business here, folks, it is diversified from the US to Canada. And if we even bleed down here, folks, we're talking about expanding into places like Chile. This is an incredible multi-billion dollar utility. And I love utilities. I love boring stocks that are going to pay me in perpetuity for the rest of my life that I can hold on to and sleep comfortably at night with. The concerns, however, that I hear from a lot of people are they are operating on an income loss. How is that even possible? Well, like real estate, you need to dabble down into the books and kind of understand the term depreciation and amortization cost. What that essentially means is the company can write down their assets, just like, let's say you bought a car. You've been driving that car for a year. It might have degraded in value. The asset might not be worth as much if you were to resell it per se. And real estate operates under the same mechanics. So if we take a look at their last earnings report for 2021, they had an earnings loss. You think, oh my God, they lost 13.9 million. But if you scroll through their net loss deductions and how this breaks up, you can see at the bottom where you see depreciation and amortization. They wrote down $97.4 million of their assets. That did not come out of their direct cash flow. It was just the properties, plants, and equipment that they would write down over time. So I mean, 13.9 million is a long ways from the 97.4 million million. So that alone, if you just got rid of that, would give them a huge positive earnings of what, maybe like $80 million. So a lot of this comes into play that you have to analyze, and we can just take a look at the revenue, because this is where things really matter to me, is that revenue. How consistent is that actual income they're producing? And we can see, guys, they hit a net all-time high revenue in the midst of the pandemic through 2020 of $1.68 billion. They did seem to slow down a little bit in 2019, but either way, the company continues to grow and scale, and they're doing a fabulous job at it. And a lot of people would also mention that the debt keeps going up, because obviously they've been doing acquisitions, taking on more debt. And we can see from 2019, they went from 6.5 billion in debt to 7.5 billion in 2020. And you'd think that's a terrible thing until you look at how much their assets have increased, going from 10.9 billion to 13.2 billion in the same time period. So their assets are growing in value actually faster than the liability is. So that's a much better sign, clearly meaning that they're making really good acquisitions and they're doing well with that debt. And utilities usually have a higher debt to asset ratio, but this one is really robust in my opinion. That is Algonquin Power. Numero dos, the second stock I'm buying June 2021 here, folks. Google McDougal. I'm buying this because I'm employed by them. I use their services. I run ads on Google. I work for YouTube. I'm in and out of this business like there's no other person out there right now, including, many of you are aware, one of my favorite companies of all time being Facebook as well. The world has done this pivotal shift. We're all at home. We're all running social media accounts. And if that is not tried and true in the earnings reports that recently came out from these companies, you are missing something incredible here. Now, I always choose Facebook over Google because, yeah, they're not as big. They don't have as many assets, which we'll see in a second. But because their PE ratio is not only lower, their market cap is much lower, they have more room to scale, in my humble opinion, or the stock to scale at a quicker pace. Because once you get to the scale of Google sitting at $1.6 trillion, obviously you're so big at this point, the money supply that it takes to raise the value of the stock gets infinitely more. But when we're talking about stability and the path of least resistance to making actual money, and even though Google sits at all-time highs with a PE of 29, which scares the heck out of a lot of people, let me remind you that these tech giants still trade at a discount to the general market. The S&P 500, the index, these companies sit at the top of, trade at a higher PE ratio right now than these tech giants. It's actually a little bit mind-boggling. But talking about the numbers behind Facebook, or Google compared to Facebook, is staggering, because when you look at the total assets, they sit at 319 billion against a total liability of 97 billion. They have over $200 billion in underlying assets. Like that is just unbelievable, considering when you look at Facebook, they're sitting at about 120 billion, so about 80 billion less overall. Still jaw-dropping in consideration. And just going through a little bit more here, guys, just take a look at the revenue growth. I mean, it's absolutely staggering. They went from 161 billion in 2019 to 182 billion. And I think going into the first quarters of this year. Now, Google, guys, I don't have to explain this to you. You guys know Google's operations. You've seen them, but you probably don't know the extent of this company's capabilities. I mean, let's just take a look at how many of their assets sit in cash right now, for that matter. I mean, their total assets, how much of that is current asset in cash? They sit at $136 billion in cash. They're getting involved in self-driving with things like Waymo. They're in every aspect of every business, and they are one of the few companies that are evolving AI. In my opinion, you are foolish for not owning companies that are dominating AI right now. These are your Apple, Microsoft, Amazon, Tesla, Facebook. These are literally the handful of companies that are dabbling down into AI, which is literally going to change the way we operate every single industry, in my humble opinion, in the coming future. Mark Cuban has been quoted saying there is only going to be the AI haves and have-nots in the future, and you want to be on the side that haves. What I'm trying to do is solidify my portfolio by owning the top companies in the world that are going to continue to dominate and disrupt, and have the cash and conglomeracy to do so, especially over the next 5 to 10 years. And right now, I already own Tesla, I already own Apple, Microsoft, and Facebook. I want to round it off by finishing it with Google and Amazon, and I will be truly happy at the core of my soul to finish for the next 10 years of my life, just purely focusing on more than likely dividend stocks with maybe the odd spec play here, folks, because, oh my goodness, I have been talking and networking with some incredible speculative companies that I think are better than a lot of the ones people are currently talking about. And I'll be working with those companies in the coming days, so you can look forward to that as well. But in light of all this, what do you guys think? What stocks are you buying June of 2021? I would love to hear about it in the comments section below. I will probably be scaling each of these to about $10,000 positions at scale for both. I'll obviously always be transparent with you and show you how much I actually end up buying for my first tranche, but consider subscribing for that. So stay cool, stay awesome, and I look forward to catching you tomorrow.